Good evening. I'm Bob Glauber. I'm a member of the faculty, Center for Business and Government, and I'm most happy to welcome you to this year's annual lecture on financial regulation, which was originally endowed by the NASD, the National Association of Securities Dealers, which is now, of course, the Financial Industry Regulatory Authority. Speaker this year is Thomas Curry, who is the Comptroller of the Currency, which is the primary regulator of all federally chartered U.S. banks, which are most of the largest banks in the United States. Tom has spoken in the forum before, most recently in a New Directions in Regulation seminar last spring. He's also a native son of Massachusetts, having served as the Massachusetts Commissioner of Banks under no less than 5 governors, which surely must be a record, from 1990 to 1991, and then from 1995 to 2003. Tom has done an outstanding job in all of these assignments, and all of us back here in Massachusetts are most proud of him. I've known Tom for a number of years, going back to his early days as Massachusetts Banking Commissioner. I've also known the Office of the Comptroller of the Currency even longer, having been responsible for overseeing it when I served as Undersecretary of the Treasury in the Bush 41 administration. The OCC, as it's known, is in fact a bureau of the Treasury, subject to the Treasury on matters of broad policy, but independent on operating regulatory matters. There's, needless to say, some ambiguity here, and not surprisingly, the OCC values its independence. A somewhat charming example of this is all Treasury stationery is embossed in green. All OCC stationery is embossed in blue, and they're very proud of it. The OCC's regulatory ambiguity, however, it really extends beyond the color of its stationery. The U.S. is endowed with what has to be one of the most complex financial regulatory structures among countries with highly developed capital markets. The OCC is in fact one of 5 federal banking regulators. The others are the Federal Reserve, the FDIC, the National Credit Union Administration, and now the Consumer Financial Protection Bureau. And of course, there are state banking regulators in each state, of which Tom was the regulator for Massachusetts for many years. In addition, there's a federal regulator for the securities industry, both brokers and exchanges, that's the SEC, as well as state securities regulators, and a federal regulator of the commodities futures industry, the CFTC. There are state, but not a federal regulator of insurance companies. So this is really quite a remarkable regulatory structure. By comparison, the UK, which is, I think people would say, a quite sophisticated financial center, manages to get along with just 2 regulators. You can easily conclude that more regulators are better than fewer, and in some ways that's true. For example, multiple regulators can provide the encouragement and sponsorship of innovation. The OCC over the years has been responsible for a number of important financial innovations, including ATM machines and adjustable rate mortgages. And in fact, the seminar that Tom participated in the spring here was on financial innovation. That said, the highly fragmented financial regulatory system in the U.S. can be responsible for conflict, confusion, and sometimes less than healthy competition among regulators, as well as a dramatic increase in regulatory cost and the burden on the industry being regulated. Strikingly, one of the consequences of the post-financial crisis ratcheting up of banking regulation has been the migration of many lending activities, formerly inside banks and under the scrutiny of bank regulators, to the securities market, overseen by the SEC, whose expertise in regulating banking and lending activities is probably not its primary strength. Yet these changes in the hope of any change in the structure of regulation is really pretty difficult to pull off, in part because of the vested interests of the firms and the people being regulated, in part because of the regulators themselves, and in part because Congress, which oversees the regulators. Dodd-Frank's record on regulatory reform was pretty dismal, I would say. It did, in fact, bury one federal regulator and created another to offset it. What I hope is perhaps either in his talk or in answer to some questions, Tom might say something about the issue of regulatory structure. But without further preamble, it's my great honor and pleasure to introduce my friend, the Comptroller of the Currency, Tom Curry, for whom Massachusetts is most proud for his long and varied service to the public. Thank you, Tom.
Thank you, Bob, for that very kind invitation. And I've really been looking forward to this event for quite a while since you initially brought up the opportunity. I think it's a perfect opportunity to discuss how we have progressed since the Great Recession and why I think we're better off today from a financial regulation standpoint than we were in 2008. And why now is not the time to change our fundamental course. It's been 8 years since the crisis that spurred the Great Recession. For some, those events are already ancient history. For others like me, it's as though it happened yesterday, because even today, we're still working to apply the basic lessons that the crisis taught. The value of strong capital and its corollary, the danger of excessive leverage, the need for ample liquidity, and the importance of effective financial supervision. With regard to capital, our banking system now is as well capitalized as any in the world. We achieve this level of capital through the concerted effort of regulators and bankers who recognize that stronger capital means stronger banks, and that banks should grow their capital during healthier economic periods so that it is available during a downturn. The crisis demonstrated that a strong capital base is an absolute necessity, and that when the market begins questioning a bank's capital strength, it might already be too late, as liquidity challenges and existential questions of solvency can quickly follow. You can see evidence of 6 years of steady progress in building capital among U.S. banking companies in the Federal Reserve's stress tests. This year's results show common equity at levels more than double that of the first quarter of 2009. In raw numbers, that's a $700 billion increase in common equity capital. This level of capital suggests that even under the most severe scenario considered under the Fed's stress tests, the 33 largest bank holding companies would continue to be well capitalized. That level of capital would allow these companies to lend into a recession and reduce the severity and length of a downturn. At this point, though, we are hearing some people question whether capital requirements have gone too far. Critics suggest the capital requirements restrict lending and place a drag on the economy. While a legitimate policy concern, the crisis provided an unfortunate reminder of the devastating consequences that can be inflicted on the public when banks fail to hold capital levels that are commensurate with their risks. The benefits of a strong banking system built on a strong capital base should not be forgotten in debates about striking the right balance in capital standards. Our capital requirements are providing resiliency to our banking system, allowing it to be a source of strength. While we have strengthened capital standards, we have done this by placing more of the burden on larger institutions that were closer to the epicenter of the crisis. Because we scaled our enhanced capital requirements to apply primarily to the largest, most complex banks, the quality and volume of capital is increasing in those institutions with the greatest complexity and systemic impact. At the same time, we are seeing lending grow and profitability beginning to return. Another lesson of the crisis that is closely tied to insufficient capital levels was the danger of excessive leverage. Leverage among financial services companies leading up to the crisis increased dramatically, particularly among the former investment banks, and we know what happened to these companies in the crisis. In response, regulators subjected large banks to stricter leverage ratios, limiting the amount of leverage they could employ. While it makes perfect sense for banks to hold capital levels commensurate with their risks through the application of aptly named risk-based capital standards, we have long recognized that such measures are not perfect. For this reason, we have employed leverage ratios to serve as an additional line of defense or backstop to the risk-based capital standards. As noted previously, we have taken a proportionate approach to constraining bank leverage by employing a slightly more sophisticated leverage ratio measure for our largest banks. One of the key features of these leverage ratio metrics for larger banks is that they capture elements that contribute to leverage that are not captured by simpler measures that focus exclusively on a bank's balance sheet. And as we have done with capital standards more generally, we have required our largest banks to meet more stringent leverage ratio requirements than smaller institutions, given their systemic importance. But here, too, some want to water down the ratios by manipulating what is included or excluded from consideration. I've been very consistent about the need for clear definitions that accurately and transparently capture the leverage of the institutions we regulate. Weakening the ratio through special exclusions only undermines our original intent and weakens the protections against excessive leverage. For example, some wish to exclude certain riskless assets from measures of leverage on the grounds that it would affect certain business lines' profitability. Yet, the essence of assessing a bank's leverage is about comparing its equity to assets, and carving out various asset classes would cut against the very meaning of leverage. In addition, if a relatively simple and straightforward metric is riddled with exceptions, it will become much more complicated and difficult to understand, which will make market participants less trusting at the most critical points of a downturn and when investors most need a clear understanding of a bank's leverage and capital. The third lesson of the crisis is the need for ample liquidity. Good memories will recall that the lack of liquidity was a significant factor in the solvency issues faced by finance and banking companies in 2008. Since then, we have taken steps in the right direction by implementing the liquidity coverage ratio and proposing the net stable funding ratio. These two ratios complement each other and push covered banks to hold sufficiently ready resources to meet short-term cash outflows and encourage banks to shift to more stable, longer-term funding by relying less on short-term wholesale funding. U.S. banks must comply with the liquidity coverage ratio by 2017, and the proposed U.S. net stable funding ratio would become effective in January 2018. These safeguards bolster the strength of our banking system and allow it to weather financial storms while still meeting the financial needs of its customers. The safeguards also make the riskiest behavior more expensive while minimizing the impact on smaller, less complex institutions that do not pose broader risks to the system. While improving capital, limiting leverage, and enhancing liquidity have helped restore our financial system, the importance of effective supervision is perhaps the crisis's greatest lesson. As a regulator with more than 3 decades of experience overseeing financial institutions of all shapes and sizes, I know supervision is the regulator's primary means of affecting behavior and promoting a healthy risk culture. In some ways, weak capital and excessive risk-taking were symptoms of unhealthy risk cultures that led to lapses in compliance and controls affecting the safety and soundness of an institution. Addressing the risk culture within the banking system was an early priority of mine as Comptroller and is a continuing theme in conversations I have with bankers, examinators, and other regulators. To address risk culture and to improve risk management in the industry, particularly in the largest institutions we supervise, we set heightened standards for management and boards of directors that establish clear expectations of governance and risk management. These standards grew from an on-site supervisory observations from the OCC. Essentially, examiners had an up-close view of what worked and what didn't work during the crisis across the industry. We took those observations and distilled them into enforceable standards for our largest banks, and we supervise against those standards today. We are making progress, but more work remains. We must be especially vigilant when it comes to practices that can undermine the trust and confidence in our financial institutions. While the crisis pointed to the need for change across the industry, it was also an opportunity for the OCC to work on its own risk culture and effectiveness. We used it to take a closer look at ourselves and how we supervised large banks, how we strategized, and how we assessed risk. In 2013, we asked respected international peers to help by reviewing our approach to the supervision of large banks. This international peer review provided 28 pages of recommendations in 6 broad areas that included mission, vision, strategic goals, risk identification, rating systems, staffing, the scope and consistency of supervisory strategies, and enterprise governance at the OCC. We went about this process in a transparent way, publishing the team's findings and what we did to address those issues. And I'm proud of our OCC employees who worked to transform the agency because they recognized that world-class organizations stay that way by seeking feedback, measuring results, and continuously improving. The many changes at the OCC over the past few years go beyond the recommendations of the international supervisors to make us a more efficient and effective regulator. We increased our lead expert program and our use of horizontal reviews to provide a more industry-wide perspective. We reduced the percentage of examiners residing on site in large banks to reduce the perception of regulatory capture. We expanded term limits and rotational assignments to ensure that examiners bring fresh perspectives to their work. We enhanced how we identify and assess risks to the banking system earlier and more effectively. We raised the profile of compliance by establishing an executive-level division dedicated to that part of our mission. We also created an Office of Enterprise Risk Management and published an enterprise risk appetite statement so that employees and external stakeholders know our tolerance in key areas. We enhanced our use of metrics to assess the quality of our work and to be more forward-looking. We increased the ties between our strategy and budgeting process so that every dollar in assessments paid by national banks and federal thrifts yields greater value in the form of more effective supervision. We established a strategic workforce plan to better manage succession and recruitment so that we can be assured of having the right talent and skill at the right place at the right time. And we are also working to ensure that we make continuous improvement, learning and growing from our success as well as our lapses. We also recognize that we need to look forward to what the banking system 20 years from now should be and what kind of regulator does that system need. We recognize that across the industry, technology and innovation were remaking how people interacted with banks and accessed financial services. To that end, as Bob mentioned, I announced the OCC's initiative to ensure that institutions with federal charters have a regulatory framework that is receptive to responsible innovation and supervision that supports it. The intent of that effort is to provide more timely guidance and decisions on innovations, increase our openness to responsible innovation that can help banks and thrifts operate more effectively and better meet the needs of their customers, and in furtherance of our mission, encourage innovation that promotes fair access by increasing the financial inclusion of underserved consumers and communities. A significant milestone in that event occurred, as Bob mentioned, right here in March, when we unveiled our white paper outlining the principles guiding our efforts. All of these changes help ensure the agency is capable of delivering effective supervision for decades to come. In the end, the measure of this work is whether the financial system is now stronger, more resilient, and more capable of satisfying the financial needs of the United States and can adapt to changing consumer demands, market opportunities, and new technology. I think and hope that the answer is yes. We can see it on the balance sheets. Tier 1 common equity is nearly 13% of risk-weighted assets, up from 9% in the fall of 2008. The leverage ratio is now at 9.3%, almost one-third higher than in 2008. And liquid assets have achieved a 30-year high of 16% of total assets. The high standards here in the United States have made our banks stronger in absolute and comparative terms. Liquid assets for U.S. GSIBs is up $400 billion on average versus $130 billion in average for non-U.S. GSIBs. Capital is up more than $70 billion compared to just $16 billion on average for GSIBs in other countries. The list of positive numbers is long. Some suggest that such a conservative posture hurts U.S. competitiveness, but that is not the case. The strength of U.S. banks has improved their competitiveness, not weakened it. In 2015, revenue for the top 5 U.S. banks was more than double that of their European counterparts, and U.S. banks' pre-tax profits of $33.5 billion dwarfed their European counterparts' $4.2 billion. U.S. banks are better today because of the rigor of new standards and how quickly we implemented them. It's also a result of earlier recognition of losses and troubled assets and the discipline to work through those issues aggressively. The progress we've made is not limited to large banks. America's community banks have gotten stronger too. Return on equity among community banks has nearly recovered to pre-crisis levels, and loan growth has been steady. To help community banks further, we have worked aggressively to remove unnecessary burden by reducing the call report, lengthening the examination cycle for well-managed banks, and encouraging collaboration as a means to address increasing costs. The hard work that U.S. regulators and bankers did in response to the crisis now has U.S. banks in a position of strength. But my job is to ask how well we, regulators and bankers, are preparing for the next stress event or downturn, and now is not the time to change course. We must remain vigilant about the levels of capital in good times so that it will be there to serve as a bulwark during the next recession. We need to manage the risks of eventually increasing interest rates after this extended period of historic lows. We have to be careful to limit concentrations in asset classes such as commercial real estate that historically have been sources of problems when the tide turns. And we have to constantly improve our defense against cyber attacks and to enhance the resiliency of our systems and institutions. Our banks are stronger today, but now is not the time to let our guard down. Those who have been in this business, and I look to Bob, for more than one cycle know that a downturn will come. Effective regulation and supervision will help ensure that the trough will not be so deep or so wide. I want to conclude by noting that lessons from 2008 were really not new lessons. Rather, The crisis reminded us of basic principles that have been around since the very first Comptroller of the currency, Hugh McCullough, provided sage advice to bankers in 1863. His advice included, let no loans be made that are not secured beyond a reasonable contingency. Distribute your loans rather than concentrate them in a few hands. Treat your customers liberally, bearing in mind a bank prospers as its customers prosper. And finally, the capital of a bank should be a reality, not a fiction. I couldn't say it better myself, and I look forward to your questions. Thank you.
I'm going to start by exercising the privilege of the moderator to ask you the first question. You talked a great deal about the increase in capital, and it's been dramatic and obviously needed. It has not been lost on the industry, where many have argued that the increase has just gone too far, and some have gone as far as to suggest that you're turning the industry into a utility. And indeed, one of the senior staff people in Treasury who was there when Hank Paulson went through the financial crisis has celebrated that. He said he thinks it's a very good idea that the industry be turned into a utility. You have views on whether, in fact, that's what's happening, and is that a good thing?
I might phrase it a little bit differently, Bob. I do think that the whole panoply of regulatory reforms and new capital standards really are designed to force the industry to reassess its structure and its risks. So I do think it's a positive overall in the sense that particularly the capital regulations that banks are looking at much more closely, how they allocate capital, how they measure the risk of those activities and the returns. That's not to say that there hasn't been and will be some disruptions in different asset classes or in liquidity itself. But overall, I think the trade-off is the benefit of having increased stability in our financial system, albeit perhaps at a lower rate of return on capital.
Okay, good. Well, now let me open the floor to questions. The rules are, as I think all of you who are frequent attendees of the forum events, please identify yourself and please ask a question. So with that, let's start. Yes, sir.
Thank you for joining us, sir. My name is Sam Leichinger. I'm a junior at the college. I'm wondering, with the rise of non-bank lenders, such as On Deck, do you think our regulators have the bandwidth and are prepared to deal with a new segment and a large segment of the industry?
All right, thank you. That's actually an area where the OCC is spending a great deal of time and thought on. As both Bob and I mentioned, we have initiated in the last 2 years an initiative on responsible innovation, and it's really designed to assess the impact of technology on banking, whether it's the delivery of credit products or the delivery of banking services to consumers and businesses alike. I think that what we're looking to do at the OCC is to try to put that in the framework of prudential supervision. What are the benefits of the regulated industry? How can we help transition banks who are looking to increase their depth in providing products and services through advanced technology, and also how fintech or technology firms can provide speed or greater inclusion and reach through products, either by themselves or with existing financial institutions that we supervise. That is going to be one of the big challenges, is the changes in how banking products are distributed and what customers want.
Thank you.
Yes, sir.
Hi, my name is Ryan, and I'm a sophomore at the college. I was wondering if you felt like there were any current forms of risky bank behavior that you find especially concerning, whether it's because you haven't found a way to effectively monitor it yet, or you feel like it's mostly overlooked by people?
No, Banking is both simple and complex. So, the basic business of banking is pretty simple. Our job is really to focus on how well banks manage the risks of existing products and services and new products and activities. We recently submitted a long-delayed study required by the Dodd-Frank Act under Section 620, which required us to look at, are there other risks within the banking system that weren't addressed by the Dodd-Frank Act? That was published just a few weeks ago. Part of our recommendation was to rethink legal interpretations that the OCC made in the 90s about investments in commodities. And at the same time that study was published by the agencies, we actually initiated a rulemaking to rescind an earlier liberal interpretation of the National Bank Act that basically allowed banks to deal in industrial commodities, which in hindsight was too liberal and too risky of an activity.
Yes, please.
Hi, I'm Julia Arnuz. I'm a 2011 graduate of the college. My question is, you've spoken a lot about the importance of trust and some progress we've made in terms of regulation and oversight. So the question for me is, and I think your talk is really timely because of this, what would you say has led to or allowed for the recently discovered massive years-long fraud at Wells Fargo, that's come to light over the past 3 years? What has allowed that, what has led to it, and what lessons can we learn from that, recently come to light fraud?
Okay, I can only comment on what's been in the public record. We issued an enforcement action in conjunction with the Consumer Financial Protection Bureau, the CFPB, and also with the City Attorney of Los Angeles. Our take primarily was really addressing flaws in the risk management practices of Wells Fargo Bank. The issue is how well did they manage and institute internal controls for a very aggressive cross-selling strategy in their retail banking network. That really fits in with what I mentioned in my remarks, our requirements for heightened risk management standards for banks. We viewed those deficiencies as being an unsafe and unsound banking practice. As part of that, we required or ordered the bank to take corrective actions with respect to their infrastructure and how they approach risk management in that area. And we also imposed a $35 million civil money penalty because of the significance of the impact on the consumers. Jointly with the CFPB and the Los Angeles City Attorney, we also ordered that restitution be made to affected customers. But again, banks need to adhere to the highest standards. This is a culture issue. You cannot, as a bank, abuse your customers' trust. That is really potentially fatal to the bank-customer relationship. And that has longer-term financial or prudential considerations that are within the purview of the OCC.
Hi, thanks for your lecture today. I have a question very specific to derivatives market and how domestic banks are positioned to handle shocks from overseas. For example, this was a few months ago, Deutsche Bank was discovered to have derivatives exposure of almost 75 trillion, which is 20 times that of GDP of Germany. So how are we positioned for that? Thank you.
Actually, I got to apologize. I had trouble hearing the question.
I can repeat the question again. Can you hear me now?
Yes.
Okay.
Thank you.
So my question was how our banks are positioned to handle shocks from overseas. Okay. Say, for example, I'm specifically looking for the size of the derivatives market in the overseas. Okay. For example, how big the Deutsche Bank itself has positioned 20 times that of the GDP of Germany. So.
Okay, that's great. I think we try to assess what the the macro risks are to our banks. Our largest banks do have substantial global, both either presence or relationships globally. So we do and have paid attention to what has been going on in Europe and other areas, whether they're political or fiscal issues there, and what's the exposure of our banks. That's something that we monitor, and how well they handle their exposure to foreign markets. I'm not going to talk about any specific banks, but this is really more in the purview of the Federal Reserve. They have established requirements for foreign banking organizations, which require their operations in the U.S. to not be in the traditional form of a branch activity, but to be under a separately capitalized intermediate holding company. And that's really designed to be a backstop against the U.S. Funding those U.S. operations in a time of stress, which happened during the financial crisis.
Let me come back to something you said a couple of minutes ago about activities in which banks are permitted to engage. You talked about limiting their engagement in commodities activities. Many people have talked more broadly about activities and focused on GlassSteagall, which greatly enhanced the activities in which banks could engage, and suggested that if GlassSteagall had not been repealed, we might not have had the financial crisis we had, and suggested it be put back in place. Have you got views on that?
I think, GlassSteagall, I don't know how effective GlassSteagall would be. I mean, I think GlassSteagall was dead before it was repealed in terms of being an effective stop or bar on non-traditional activities by banks. I do think that what we're looking for with banks, generally speaking, you have to look to the four corners of the National Bank Act and whether those activities are permissible. And it's very broad, but you've got to have that nexus back to banking. I think when you're talking about things like commodities, dealing in commodities, particularly those that may have tort liability associated with them, is a significant risk that banks may not have either the ability or the capacity to protect against. I think what I was referring to was just a cultural thing. I think back in the 90s, and I think we were all looking for what is the reach of banking? Can we expand it through interpretation of the permissible activities? The specific rule that we're changing, just to give clarity, was we interpreted the ability to deal in bullion to include industrial sizes of copper and other industrial metals.
Got it.
And that, in 2020 hindsight, in the direction of 620 of Dodd-Frank, we reassessed and said that was an extreme interpretation. And we're in the process of repealing it through our rulemaking.
Got it. Thank you. Yes, sir.
Hi, and I'm David, and middle career MPA students in Kennedy School. So I have a question about the systematic important banks. So there's lots of discussion about the systemic risk generated by big banks. But actually in the financial crisis, there was a consolidation in the banking sector. For example, in America, and Bank of America and merged with Merrill Lynch. So actually big banks and become even bigger and more systematic important. So do you think in the future we have a better resolution mechanism for future bank crises? Thank you.
Okay. As Bob knows, the traditional way of dealing with a banking crisis is to have larger institutions acquire weaker institutions. And that's essentially what happened prior to the Dodd-Frank Act. During the crisis, basically our largest banks acquired investment banks like Merrill Lynch and Bear Stearns that their demise would have had a significant systemic impact on the system. So that created or in the case of Wells Fargo, their acquisition of Wachovia, that created really very large institutions. The Dodd-Frank Act effectively really has put a stop to any additional growth by acquisition for our largest banking institutions. That does not preclude them from growing organically through different business lines as well. There are other provisions of Dodd-Frank, and Jim Siegel knows because he was a player in that, are on the things like how much in deposit insurance they have to pay, other restrictions on activities. So there's other measures to restrict the exposure of larger institutions to the financial system. The creation of the Financial Stability Oversight Council is to make sure that if there is a migration of activities into the non-bank section, you have a mechanism to designate non-bank systemically important financial institutions and subject them to oversight by the Federal Reserve System. So that's the basic structure of the Dodd-Frank Act and how you can limit, at least put a cap on the size of our largest domestic financial institutions.
Yes, please.
Hi.
Hi.
I'm a sophomore at the college. How do you think the upcoming election will affect issues in bank regulation? And do you think it will change the course from what sounds like one that is very positive right now?
I think financial regulation is an issue and has been nationally in the debate over public policy. I do think there are different positions that have been staked out. On the one hand, I think there's the retention of Dodd-Frank and potentially additional regulatory or statutory provisions being addressed to deal with non-bank, the migration of activities to non-banks. Then on the other side, Congressman Hensarling has advocated a much more radical approach to bank regulation. Basically, any bank, if you have 10% leverage ratio, then you have the opportunity to be exempt from almost all existing financial regulation. And that's designed as an elective rather than a mandatory requirement. From our standpoint at the OCC, we recognize that Congress is our boss. They've told us what to do on Dodd-Frank, and we're continuing to do it. If there's a change in national policy, we will do what we're supposed to do.
Thank you.
Well, yes, sir.
Hi, my name is Martin Chorzempa. I'm a second-year MPA ID student. I'd like to ask you about the absorption of the Office of Thrift Supervision into the OCC and what challenges that's posed, and then what the implications of that would be for whether it would be ideal to bring together some of the current alphabet soup of regulators we have in so many different overlapping and somewhat distinct areas, whether that maybe the lessons from merging two very different regulatory organizations would have for that process.
Okay. I think what's interesting about the OTS experience, and I came in to office midway into its absorption into the OCC, I was very used to looking at bank-to-bank acquisitions, and it was really an abstract process, but we were basically faced with an integration issue, and I have to confess it's a lot harder to do when you have to do it. Cultural issues, just making sure that examiners have paycheck and laptop were surprisingly complicated and complex. In terms of the other aspect of your question about integrating or consolidating the financial regulatory agencies, some have observed if Congress did not consolidate the banking agencies during Dodd-Frank, during the Great Recession, when will they? My view on becoming Comptroller was, all right, we've got these multitude of regulators, let's try to have a practical solution. So I've advocated from day one the need for enhanced collaboration with our colleagues. And I don't mean coordination, I mean collaboration. That takes a lot of work and a lot of effort. Sometimes it means you're dancing by yourself, but I think we've made a lot of progress, particularly among the federal banking agencies, the Fed, the FDIC, and the OCC. Much more coordination in rulemaking, much more coordination in the development of policy, capital policy. That needs to be extended to our market regulators, with which we do not have as long of a relationship. And people ask me what the value of the FSOC is. I think at a bare minimum, it's been significant in that you get to know your regulatory counterparts. And if you're in a crisis and you have to rely on another agency head, you want to know whether how far that you can trust them, or on the alternative, at least how far you can trust them. And if you're hitting it cold, you're going to have additional complications. So, for the time being, we're focusing on collaboration, and we'll await further instructions from Congress.
Tom, you talked about stress tests and also about transparency, and you talked with stress tests of how important a regulatory device they've become, and I think that most everybody would agree with you. On the other hand, they are basically non-transparent, and some people have argued that they really ought to be made more transparent. Have you views on that?
Well, there's two types of stress tests under Dodd-Frank. There's a depository institution level where the banks do the stress test, but the banking supervisors, the OCC, the Fed, and the FDIC provide the three different scenarios that they have to run through. That is more transparent in the sense that we publish the scenarios. We also are in a staggered public disclosure, limited public disclosure of the results. The CCAR, or the company stress testing that the Fed provides, is less transparent or more opaque. I think the argument there for keeping it that way is as a protection against gaming the system. I don't know enough about it's opaque even to me in some respects, so I don't know enough to comment on it substantively.
But systems can be gamed.
Yes,
and they have been gamed. And
that's really the reason why we strongly support the leverage ratio. Since Basel II, which really encouraged institutions to model risk within their own institution as a means of establishing the appropriate risk-based capital levels. There's a history of gaming, and internationally, this is really what we're trying to deal with the Basel Committee today, is the very excessive variability between in risk-weighted assets between countries and supervisors. So the value of a leverage ratio is it's pretty clean and simple.
And that's very interesting. You were talking a minute ago about cooperation among the regulators. Leverage ratio is a good example. Back in my days, there was a very strong disagreement among regulators about the value of a leverage ratio. And your agency had particularly strong views, as did other agencies. It's interesting that you've come to a point now where you all embrace the leverage ratio.
Yeah, capital ratios are like religious sects. There's some that prefer the risk-based approach because it's more sensitive and tailored than those that view you need to have a baseline that you can measure. And as I mentioned in my remarks, that's particularly important during a period of crisis. At the end of the day, during the crisis, people weren't looking at the industry's risk-based capital ratios. They were looking at tangible capital, and that's really what counts.
Yeah, and what you say about gaming, I think, is true. I mean, if you have a risk-based system, it invites people to figure out how to look best under that risk-based system.
Yeah, and I think we made a concerted effort to make sure that there was a credible challenge to the modeling of our institutions. But again, that's not a perfect system. And there is an issue of international adherence.
Good. Yes, sir.
My name is Dean Anderson, and until June, I was managing grid engineering at Bank of America. I worked there for 6 years. I'm not a banker, I'm a technologist.
Good.
And you mentioned fintech, and my question relates to financial technology. In the 6 years that I was at Bank of America, I never talked to a regulator. There was no regulation at all that I could see on technology. The structure of the regulation is that if you don't compute the quantitative risk analytics, you don't get to trade. So on the one hand, I have applications saying, you need to be able to compute this, and here's the quants over here to how to compute it. But in light of, for example, United Airlines going offline for several days, is there any thought to technology regulation? How would you go about doing that?
You may not have experienced the regulation of technology at Bank of America, but that is something that's been a component of our examination programs for decades. We do technology exams, IT exams of institutions. We also have formal guidance on model testing and validation that banks are expected to follow. What's happened more recently is we've been emphasizing the bank's cybersecurity defenses, and that's becoming an increasingly important aspect of our IT examination activity.
Yeah, but if the supercomputer fails, the risk reports don't get done, the bank stops operating, and no one has ever come to look at that. I mean, I'm aware of the cybersecurity, we do upgrades. You know, 100-day limit was a big deal. But the underlying supercomputer, no one has looked at ever. You know, if that doesn't work, the whole thing grinds to a halt.
Sure. I mean, you know, basically, it's a layering effect, first line, second line of defense. We expect the bank to actually do appropriate bank-level testing of critical systems. You know, part of our examination activity, whether it's even the loans of an institution, you know, you do a sampling, so you're not necessarily going to hit every system or every loan in a particular in a bank. But you try to assess through that sampling technique and appropriately whether or not there's compliance. All else fails, our expectation is that you have the ability to resume business. Well, what's your business resumption planning capabilities, and having the appropriate level of redundancies to do that. So that's the kind of the approach that we have from a supervisory standpoint. It's not so much an audit function where you're tracing something down to its root element.
Thank you.
Thank you.
Hi, I'm Teddy. I am a freshman at the college. So this summer we saw a lot of instability with the pound as Brexit happened. So as we saw that happening, what were your short-term and long-term thoughts? And then what plans do you have to ensure future stability?
Okay. Again, there was an earlier question about what was going on in Europe. We look at macro events to see what potential impact they'd have on the bank. So in terms of Brexit, that was something that we would be monitoring with the other federal banking agencies and with our counterparts overseas. With Brexit, the more practical implications of it are real. You know, London is a financial center. Our banks have significant presences in the city. It's really an issue of, going forward, how do they plan for a potential exit under Brexit, and what will that do to their foreign activities, and does that present any licensing or substantive issues for the OCC? But again, I think we're in the early stages of what Brexit means and what individual bank strategies are for dealing with potential scenarios under Brexit.
Good evening, sir. My name's Amy. I'm a mid-career MPA student in Kennedy School. I'm from China, and in recent years, in China, Chinese government kind of encouraged the internet development, and including the internet, so-called internet banking. And just because of the government encouragement and lack of regulation, I think there's some unfair competition between the conventional bank and the internet bank. So I don't really know the situation in America, and if it does, there's so-called internet banking. Is there the government support this type of banking system, and are there any complete regulation follow?
When it comes to distribution system, there isn't a preference. I think our view is, banks can choose the technology that they think is appropriate to deliver their products, as long as it meets our general prudential considerations, that there aren't risks, reputational risks or operational risks that haven't been addressed. So there's not a preference. We think it's really not a government responsibility to dictate the manner in which banking services are delivered. But if you do make that choice, you need to make sure that you've addressed all appropriate risks. In terms of what the potential benefits or downsides of two delivery options, whether it's a brick and mortar branch or internet banking services, our role is really to make sure that with respect to brick and mortar branches, that if there is a decrease in the number or the location of those branches, what impact it has under the Community Reinvestment Act, which is based on a geographical location of bank branches and how bank provides credit and banking services to low to moderate income consumers. We also think from an access or inclusion standpoint that cheaper, more readily available electronic delivery systems are a societal benefit, as long as they meet the needs of their consumers. And we would, theoretically be concerned with the development of a tiered system of the quality or depth of services based on income or geography. But
could a pure internet bank meet the Consumer Reinvestment Act statute?
Yeah, that's one of the issues I think that ultimately Congress will have to address, whether it's internet banking or other credit that's provided on a national basis. It has the potential not to be captured because you measure the Community Reinvestment Act activities based on your assessment area, which is centered around physical locations.
Absolutely.
What we've encouraged on a less formal basis through published CRA question and answers is to give greater flexibility for institutions to go beyond their core geographical area and to give credit if it has a meaningful impact on those areas.
Got it. Good. Well, listen, my job is to make sure this ends when it's supposed to end. Tom, thank you so much for coming back and seeing us.
Thank you.
Oh, this is wonderful.